Welcome to the Payback Channel. My name is Thomas Allen Moon. I'm the creator and host of the Payback Channel. The purpose of the Payback Channel is to help Americans who have ordinary money-making skills, in other words, America's middle class, understand what they have at stake regarding how much America taxes, how it taxes, and who it taxes. In this episode, I'll discuss four major tax issues: what tax preferences are, who they benefit, how they corrupt America's capitalism, and how they pervert America's politics. The first issue regards what tax preferences are. There are special provisions in the personal and corporate income tax laws, which, as defined by Congress in the Budget Act of 1974, quote, allow a special exclusion, exemption, or deduction from gross income, or which provide a special credit, a preferential rate of tax, or a deferral of tax liability, close quote. Congress intended that special provisions are to be defined with reference to a, quote, a normal income tax law, close quote. The normal income tax law, as intended by Congress, envisioned taxing income broadly defined, with deductions only for the standard deduction under a rate structure applicable to all taxpayers. Additionally, businesses would be able to deduct investments and business employee expenses. All provisions of the tax laws, other than the standard deduction for individuals and deductions for investment and employee business expenses for businesses which permit a reduction in tax liability, are considered as special provisions. What makes these provisions special is that they each prefer a special class of taxpayer over all other taxpayers by granting them unique benefits. Special provisions outside the normal income tax law, tax preferences for short, prefer some taxpayers over others by permitting an exclusion from taxation for some or all of certain types of income, permitting a deduction from taxation for some or all of certain types of expenditures, permitting a credit against taxation for some or all of certain types of expenditures, taxing at preferential rates certain types of income, permitting a deferral from taxation for some or all of certain types of tax liability, and granting certain types of special credits to preferred groups of taxpayers. In each of these cases, the political process decides what certain types means. Decisions about the meaning of certain types often results in preferred taxpayers avoiding paying thousands and sometimes millions in taxes, and non-preferred taxpayers paying more in taxes. Each tax preference enables taxpayers who have the same income as others, but who qualify for one or more tax preferences, to pay less taxes than those who don't. So beneficiaries of tax preferences enjoy a higher after-tax standard of living than all other taxpayers. Revenue losses attributable to tax preferences are called, quote, tax expenditures, close quote. Tax preferences do two bad things. First, they reduce revenue, and second, they enrich the preferred class of taxpayers at the expense of all other taxpayers. Also in the Budget Act of 1974, Congress concluded that tax expenditures, quote, may be considered to be analogous and to direct outlay programs and are similar to those direct spending programs that are available as entitlements to those who meet the statutory criteria established for those programs. Put simply, this means that taxes saved by taxpayers who benefit from tax preferences are, in Congress's view, similar to benefits payable to beneficiaries of entitlement programs. Under this theory, a billionaire real estate developer who saves $10 million on taxes because of a preferential rate on his capital gains income is as much entitled to his tax savings as Social Security beneficiaries are to their payments. Suppose tax preferences didn't exist and a real estate billionaire came to Congress and asked for a special appropriation of $10 million just for him. If he did, he'd have to compete with all other Americans for a taxpayer-subsidized appropriation from Congress. Hopefully, he'd be laughed out of Congress. But because of tax preferences, that same billionaire routinely pockets his $10 million tax expenditure. In fact, tax expenditures are government spending by another name. Revenues lost because of tax expenditures must be made up by either increasing taxes on non-preferred taxpayers or adding to the national debt. The political process, that's politicians and the lobbyists and others who influence them, determines what qualifies as a tax preference, how generous it is, and who qualifies for it. Each tax preference is born of a tryst between politicians who depend upon political contributions for their survival or advancement, and well-financed lobbyists who support accommodating politicians. The more political clout a taxpayer has, the more likely it is that the taxpayer will benefit from tax preferences. Using the political process to prefer some taxpayers over others results in preferred taxpayers, those who have political influence, enjoying a higher after-tax standard of living, and non-preferred taxpayers, those who have little or no political influence, suffering a lower after-tax standard of living. Tax preferences are examples of the political process, not the marketplace, determining winners and losers and who has the most after-tax income. Tax preferences proliferate to tax laws. There's over 200 of them, with some affecting only very few taxpayers and others affecting many. Let's take a few moments and scroll through them to see what kind of special deals some influential taxpayers get. I've highlighted only a few of the tax preferences as examples that have affected the tax laws. As we look at each tax preference, imagine who supported its enactment, how many and what kind of taxpayers benefit from it, what's the justification for it, and why it should continue. On the first page, why should there be a deduction for foreign-derived intangible income, and why should there be a reduced tax rate on active income of controlled foreign corporations? On the second page, for those who believe in market solutions, why should there be a credit for alternative technology vehicles, and why should there be a credit for refined coal? On the third page, why should there be an exclusion for energy conservation subsidies provided by public utilities, and why should there be exceptions for publicly traded partnerships with qualified income derived from certain energy-related activities? On the fourth page, why should there be special treatment of income from exploration and mining of natural resources as qualifying income under publicly traded partnership rules, income derived from certain energy-related activities? On the fifth page, why should there be an exclusion of interest on state and local government small issue qualified private activity bonds? On this one, I know quite a bit about it because as a retired bond lawyer, I worked with commercial bankers and investment bankers to package these deals. I doubt that these deals help any taxpayers other than a very, very few well-off taxpayers. But these deals sure help me and a bunch of bankers make a lot of money on fees. On the sixth page, why should there be a deferral of gain on non-dealer installment sales? On the seventh page, why should there be special treatment of life insurance company reserves? And why should there be an exclusion from gain on certain small business stock? On the eighth page, why should there be a deferral of tax on capital construction fluids of shipping companies? On the ninth page, why should there be a credit for holders of qualified zone private activity bonds? On the 10th page, why should there be a deferral of taxation on spread on acquisition of stock under incentive stock option plans? On the 11th page, why should there be an exclusion for employee benefits relating various types of insurance? This one's easy. Employees, employers, insurance companies love it. Employers get a subsidy for their insurance, and it helps insurance companies sell their insurance. However, for employees who don't get employer-paid insurance, and there are many millions of them, it's not such a good deal. On the 12th page, why should there be tax-benefited retirement plans like IRAs? This one too is easy because taxpayers who can afford them, mostly well-off taxpayers, love them. But for taxpayers who can't afford them or don't have the discipline to use them, they don't do much good. On the 13th and final page, why should there be an exclusion of the interest on public purpose state and local government bonds? Again, on this one I know quite a lot about it because I worked on these deals for 20 years and made a good living doing it. In theory, tax exclusion causes the bonds to be sold at a lower interest rate, and therefore it benefits state and local governments and their taxpayers. In reality, the rate differential isn't great enough to do much good for state and local governments, but it sure does enable both wealthy taxpayers to shelter much of their income and a swamp of tax professionals to make big fees. Some of these tax preferences help those who most of us agree deserve and should get taxpayer help. But tax preferences are a clumsy and unfair way to go about it. There are better ways to provide help to the deserving and needy. All of the over 200 tax preferences have special constituencies who swear by them. But if those millions of taxpayers who don't benefit from them understood them, they'd swear at them. Just like the purpose of a bucket is to carry water, the purpose of the tax laws is to raise revenue. Imagine the utility of a bucket after it's been riddled with 200 rounds from an AK-47. Well, that's the utility of tax laws having been riddled with over 200 tax preferences. Congress has long known that a growing hodgepodge of tax preferences threatens to both lose too much revenue and too generously reward too many unneedy preferred taxpayers. In 1926, Congress created the forerunner of the Joint Committee on Taxation, the JCT for short, to monitor tax policy and report its effects to Congress. The JCT is made up of senior members of both parties, of the Senate Finance Committee and the House Ways and Means Committee, and has a largely nonpartisan, highly professional staff. The JCT is the recognized arbiter in Congress of all matters regarding the evaluation of and reporting on tax policy, and its reports are relied upon by the CBO, that's the Congressional Budget Office. By law, the JCT is required to report annually to Congress how much revenue is lost due to tax preferences, how they affect the distribution of the tax burden, and how they affect the economy. As a part of its periodic budget and economic outlook reports to Congress, the CBO also tracks the effects of tax expenditures on the budget. For 2019, the CBO estimated that tax expenditures totaled more than $1.6 trillion, or 7.8% of GDP. Total revenues were only 16.1% of GDP. As shown on a chart prepared by the CBO, tax expenditure spending is almost one half of all tax revenues. It's about the same as total income tax revenues and exceeds non-defense discretionary spending. Non-defense discretionary spending is what most people think of as government spending. It's all spending other than defense spending and spending on entitlement programs such as Social Security, Medicare, and Medicaid. The CBO listed its 10 largest tax expenditures for 2019 as follows. Leading exclusions include the exclusion of employers' health insurance contributions, which cost an amount equal to 1.4% of GDP. The exclusion of pension plan contributions and earnings, which also cost an amount equal to 1.4% of GDP. Leading deductions include accelerated depreciation for qualified property purchased by businesses, which cost an amount equal to 0.3% of GDP. The 20% deduction for qualified business income available to pass through businesses, which cost an amount equal to 0.2% of GDP. The itemized charitable deduction, which cost an amount equal to 0.2% of GDP. Leading preferential rates include the preferential rates on dividends and capital gains, which cost an amount equal to 0.6% of GDP, and the reduced rate on active income of controlled foreign corporations, which cost an amount equal to 0.3% of GDP. Leading credits include the credit for children and other dependents, which cost an amount equal to 0.6% of GDP. The earned income credit, which cost an amount equal to 0.3% of GDP. The premium credit, which helps those with low and moderate income purchase health care insurance under the Affordable Care Act, which cost an amount equal to 0.3% of GDP. The big takeaway about what tax preferences are is that they are tax laws that confer special benefits on politically preferred taxpayers, which are paid for by non-preferred taxpayers. The second issue regards who benefits from tax preferences. This one's simple. The more income and wealth you have, the more likely it is that you'll get the glutton share of tax expenditures. For at least the last two generations, globalization and automation have overly concentrated income and wealth at the top. Progressivity of taxes based on the ability to pay helps mitigate the overconcentration of income and wealth. The normal income tax is progressive because it defines income broadly. It has a standard deduction which both exempts those with low income from taxes and disproportionately reduces the taxes of most moderate income taxpayers. And it has a progressive rate structure, which ranges from 10% to 37%. Tax preferences, however, negate much of the progressivity of the normal income tax. Progressivity in taxation requires a broad tax base which includes all forms of economic income and treats all forms of economic income the same. Economic income not only includes income from wages and salaries, but also all income resulting from the ownership of assets and the receipt by a taxpayer of anything of value from any source. Instead of a broad tax base, however, the political processes use tax preferences to narrow it. Adjusted gross income, or AGI as the IRS calls it, is the income that the political process has chosen to tax. Tax preferences exclude many forms of economic income from being included in AGI. So AGI is political income, not economic income. The BEA, that's the Bureau of Economic Analysis, calculates personal income in economic terms, not in political terms. In 2014, the BEA reported that the total personal income was $14.9 trillion compared with only $9.7 trillion of AGI. This means that $5.2 trillion of economic income escaped taxation because of tax preferences. The best kind of income that a taxpayer can have is that which isn't taxed, and most of that tap belongs to upper income and wealthy taxpayers. As broadening the tax base increases the progressivity of the personal income tax, so too does increasing the standard deduction. In 2018, the standard deduction for a married couple filing jointly was $24,000, and for a single person, $9,700. The amount of the standard deduction is a rough approximation of the minimal amount of income needed to stay out of poverty. While the standard deduction largely prevents the personal income tax from taxing those in poverty, it doesn't apply to the payroll tax. Every poverty-stricken wage earner, no matter how poor, pays the payroll tax on every dollar of income they earn. Just as broadening the tax base and increasing the standard deduction increase progressivity, so too does increasing tax rates for high-income taxpayers and lowering them for low-income taxpayers. Today's rate structure could easily be made more progressive by raising the tax rates at the top and lowering them in the middle and at the bottom. While most tax preferences enrich high-income and wealthy taxpayers, 3 major tax credits are targeted to help low and moderate income taxpayers. Targeted tax credits include the Earned Income Credit, the Child Tax Credit, and the Affordable Care Act Health Insurance Premium Credits. The explicit purpose of the targeted tax credits is to provide supplemental income subsidized by taxpayers to workers whose market income isn't enough to have a decent standard of living, so that they too can have a decent standard of living. The implicit purpose of most other tax preferences is to provide supplemental income subsidized by taxpayers to high income and wealthy taxpayers to enhance their already affluent standard of living. Since Congress regards tax expenditures as the equivalent of, quote, direct outlays, close quote, those who benefit from them are treated the same as beneficiaries of social insurance. It's a fair question to ask why high income and wealthy taxpayers should be entitled to payments made from tax expenditures that are the equivalent of social insurance payments made to the needy. Tax expenditures attributable to targeted tax credits amount to only about 15% of total tax expenditures, leaving over 80% of tax expenditures to benefit many high-income and wealthy taxpayers. Reviewing how the top 400 taxpayers avoid paying billions of taxes reveals the clearest proof that tax preferences undo much of the progressivity of the normal income tax. By law, the IRS has tracked the personal income taxes of the top 400 taxpayers since 1992, with 2014 being the latest year for which statistics are available. In 2014, the average AGI for those in the top 400 was $317.8 million, and their average effective tax rate was 23.12%. Tax preferences, many of which either excluded their income from taxation or taxed at lower rates than wage income, enabled the average taxpayer in the top 400 to save almost 13 percentage points, or $42.2 million, on their taxes. Within the top 400 taxpayers, 9 had an effective tax rate of less than 10%, another 26 had an effective tax rate of less than 15%, and another 75 had an effective tax rate less than 20%. As a comparison, poverty-stricken wage earners bear a burden of 13.45